Cavalry has arrived in the form of the FBI, CFTC, SEC and the Southern District of New York, which is a federal trial court. Look, it has taken almost a month, but in terms of the federal government and the various agencies working together to combat white-collar crime, this is fast. A federal grand jury has accused co-founder and ex-CEO of FTC Sam Bankman-Fried, SBF, of widespread fraud that has led up to the collapse of the cryptocurrency firm. The charges are as follows. SBF defrauded clients of FTX.com. SBF defrauded lenders to Alameda Research, the FTX hedge fund. SBF defrauded investors in FTX. SBF violated campaign finance laws. This is serious. Broadly, there are three groups of victims: FTX clients, lenders to Alameda Research, the United States. The indictment filed with the US District Court in the Southern District of New York has SBF with 8 criminal counts, including wire, securities and commodities fraud, money laundering and campaign finance violations. On top of the criminal complaint, the SEC and the CFTC has also charged SBF with fraud. The director of the SEC's Division of Enforcement asserted that FTX was a fraud from the very beginning, that SBF personally borrowed more than $1.4 billion from Alameda Research using customers' money for investments, real estate and political donations. It was emphasised that SBF had projected FTX as a safe place to invest because of an automated risk engine that would sell off customers' assets to make sure collateral stayed at the required levels. There were clearly no risk controls. It is alleged in the SEC and the CFTC filings that SBF misappropriated the assets that FTX clients had deposited with the FTX platform exchange and used them to pay expenses and debt at his Alameda Research hedge fund. The complaint states that SBF lied to both clients and investors conducting the alleged illegal activity over a period from 2019 to early November 2022. The civil complaint was filed with the Southern District of New York, claimed that SBF had raised more than $1.8 billion from investors who bought an equity stake in the exchange, believing that FTX had appropriate controls and the automatic risk management. The SEC has further alleged SBF with violating anti-fraud provisions and demanding a set of orders that will prohibit him from handling securities professionally and prevent SBF from serving as an officer or director of a company moving forward. SBF was arrested at his home in the Bahamas. He told the court in the Bahamas that he would fight extradition to the US. There was a limited chance that this would be successful. A magistrate judge in the Bahamas has ordered SBF to be held until February 2023. All of this hours after the US federal criminal indictment was unsealed. Yesterday, SBF was supposed to testify before the House panel investigating the FTX crash. At the hearing, the new CEO and insolvency lawyer John Ray III, who was involved in the bankruptcy case of Enron more than 20 years ago, stated that SBF was grossly inexperienced and what happened at FTX was old-fashioned embezzlement. In fact, he stated that the Enron case was much more sophisticated. There is the question about the possible length of jail time. There are a couple of aspects to consider in determining jail time. The number of victims. As described, there are 3 groups, thus serving consecutive rather than concurrent sentences could be more likely. If the fraud amount is over $500 million, which is certainly the case, then if convicted, SBF could get the maximum enhancements. In short, 20 years plus is not out of the question. For us normal people, on the scale of scams, FTX was relatively complex. Be aware, the scammers are out there, and keep in mind the 9 most common scams. Fake websites. Scammers sometimes use fake platforms for trading cryptocurrency or fake versions of official cryptocurrency wallets. They commonly work in 2 ways: to steal your information or to steal your money. Email scams. Scammers go after the private keys that are needed to access the funds in a crypto wallet. Once the hackers have this information, they'll steal the cryptocurrency in those wallets. Pump and dump schemes. Fraudsters do this by getting people excited about a certain coin or token, then driving up the price. Then the scammers sell their assets once the price is driven up, which causes a crash in the value of the token. Fake assets. Scammers often use fake apps that can be downloaded from Google Play and the Apple App Store to trick people who want to invest in cryptocurrencies. Both Google and Apple have been very fast to get rid of them, but be aware. Endorsements. Scammers who try to steal cryptocurrency may pretend to be celebrities, business people, or influential people, or say that they have their support. They could sell fake cryptocurrencies to investors who don't know much about them. Freebies. Scammers profit to match or multiply the cryptocurrency sent to them in what's called a giveaway scam. Blackmail and extortion. Scammers also use blackmail as a method, sending emails claiming to have a record of potential embarrassing activity. Cloud mining. Cloud mining is the practice of renting mining hardware from a company. Many cloud mining companies are scams. You either lose your money or make much less than what was promised. ICOs, initial coin offerings. Potential customers are promised a discount on a new cryptocurrency if they send active cryptocurrencies like Bitcoin or another popular cryptocurrency. So be aware, scammers are out there. So if you like these videos, hit the like and subscribe. It really does help the channel, and keep watching the quick definition videos.